Welcome to the Broken Pie Chart Podcast, episode 138. I'm your host, Derek Moore, and back this week as my guest, my semi-permanent co-host, Jay Pestruccelli. Jay is the CEO of Zega Financial and increasingly a media darling in the financial press. Jay, how you doing today?
Good. Thank you for that. Darling might be a bit of an exaggeration, but it's great to be back. And I always try to bring up the Broken Pie Chart, podcast in my media appearances.
Yeah, I expect, by the way, we were kind of off air. We were kind of laughing. You're scheduled to be on Mornings with Maria Bartiromo on Fox Business tomorrow. Of course, when people are listening to this, it will have been in the past. I think you're scheduled for around 7 a.m. So sadly, Jay, that's 4 a.m. on the West Coast. I may have to tape that one, but
I think I'll give you a pass on that one, buddy. You get a pass on that.
Yeah. The good news is, you ever do like Bloomberg Europe? I'm in for that one. That's I'm still up sometimes.
Our Bloomberg schedule for the October 19th is 6 and 7 o'clock Eastern. You'll definitely be up for that.
Oh yeah, for sure. It is funny too, because living on the West Coast, and it's I've watched Bloomberg like before I go to bed, because it's kind of their morning, their Europe morning. And I'll watch it sometimes, just to get a feel for stuff. I don't have CNBC World though. I don't know if you have that on your.
I don't. Right after after Kramer's on, then it starts to flip over to things like what is it, Shark Tank, and some of the other primetime shows, right?
Yeah.
I don't have the worldwide one. Yep, I watch Bloomberg for the overnight stuff too. Yep, exactly. Bloomberg's a little more technical too. I know that's not what you wanted to talk about, but I do enjoy, they get a little into the numbers like you and I prefer to do.
I agree. I mean, I think CNBC does more quote unquote newsy things, where Bloomberg sticks to finance a little more. And they get technical. I mean, we're technical analysts, although we don't use that as a primary method of, making trading decisions, of course. But yeah, I mean, I would agree. I think it's, and even that Cheddar. I like the graphics on Cheddar Business, by the way. You were on that a couple weeks ago, and they do the purple, right, or the pink.
Yeah, it's like a pink, purple. Yes, they've been around for 5 years. They're for real. I think at first people weren't sure, but they are definitely doing their thing. They're for real.
That you can get on. You can actually Bloomberg via the app, but you can also get Cheddar Business on Pluto app, which has a lot of free stuff. Anyway, this is not the podcast to talk about streaming. That's other podcasts. Actually, before I transition to, because we want to talk about CPI, shipping container prices, I may be making a call there, and I say that jokingly, because none of us will ever trade off that. And then really our primary thing is some interesting numbers and research you've been doing on tech earnings before and after the release. But Jay, Succession comes back this weekend on HBO, the third season, and it is a lot of family dynamic in that, but it is loosely on business. There's some M&A, mergers and acquisitions stuff in there, but I give a strong recommendation for that's on my conviction list, Jay. I think you would.
Yeah, and you turned me onto it. I wasn't always sure to watch it. You said, Jay, trust me, watch it. I watched it, and it was a great recommendation, Derek. It's one of your better ones. You've had some great recommendations for.
Yes,
now
thank
that
you.
we're in the binge watching world. Binge working. Yeah, that's like not a new thing, but binge watching. Yeah, great show. I recommend Succession too. Like hostile takeovers, right? Private equity, all kinds of financial connections within that show.
The guy, yeah, and the guy who all the character actors are tremendous, and I think if you've never watched it, go back and watch season 1 and season 2, obviously before we watch the premiere of season 3. But it starts off a little bit slow, and you just gotta sort of let it get going. But yeah, no, I agree. There's Billions just ended, and Billions has a lot of stuff in it too. Although I was laughing. I don't know if you remember the episode where the compliance guy came in and grabbed the marker, and he starts writing a formula on the board. And I think it was supposed to be a value at risk formula. And I froze the screen, and I looked at it. I'm like, I don't think that's really the complete value at risk formula. I don't know what that was. You saw that though, right?
I did, and he did make a mistake, and then later in the show, they're like, "You're wrong. You got the wrong numbers going." I think it's when they were trying to get out of like an energy position. It was like natural gas, and they were trying to get out of a position, and they were pushing the positions out to all their brokerage sources. That was a very tradey, like a trade-ish type episode. Love Billions. It's really, I feel Billions is mandatory watching in our industry. I don't know a single trader that doesn't watch Billions.
Yeah, it's a billion Succession, and then I mean, yeah, I mean, obviously Wall Street is the quintessential classic from 1987. Believe it or not, that was so long ago. But anyway,
Gordon
we'll
Gecko.
trends.
Greed,
Yeah,
greed is
Gecko.
good.
Do you know? So did you have suspenders? I had suspenders, and I had a blue shirt with a white collar back when I worked on Wall Street.
Not when I worked in finance, but in a restaurant I did. But that's a whole
Yeah.
different lifetime ago.
Yeah. Okay. Yeah. That's like a Farrell's. Like, were you working at a Farrell's restaurant with the
Yeah, I have
ice cream?
my flair, and have my 17 pieces of flair. So somebody will
Yeah.
know what that is.
All right. So transitioning from suspenders, blue shirts, and white collars, which Gordon Gecko, of course, donned in that movie. Some news this week. Let's start here. I say this with a smile and air quotes. Congratulations to people getting Social Security. It looks like you're going to get about a 5.9% cost of living adjustment, or COLA. And the way they do that, and before anyone emails in and says, there's something nefarious here, they look at Q3 of last year to Q3 of this year. The reason why they do that and not Q4, year end to year end, is you have to make these changes. The final inflation numbers don't come out until October, that ended in September. So if you waited till the end of the year, you wouldn't know the change until January, and then the year already started. So they got to get the checks ready. But 5.9%, Jay, that's probably the biggest we've seen in 30 years.
Yeah, I mean, since I've been looking at it, for sure. I wasn't really looking at those changes in my early 20s. But yeah, this is a big deal, and it's great that it's appropriate. And, it's one of those things that even though the savers of the world have been kind of hurt by lower rates over the last, decade. This is something when inflation actually helps people that are getting paid on that. When we do our math, Derek, that's a data point that we input, right? When we try to figure out, okay, based off of when you're going to retire, when you're going to take Social Security, how much you're going to take in, how much do we have to make to offset your additional expenses? It's a real important number, and this is a high one for sure.
Yeah, no, I would agree. And you're right. It does. Maybe in a future episode, we'll talk a little bit about some of the ways we do that, because we've got I'll put a link in the show notes if anybody wants to check out Zega's growth simulator. So there you can type in expectations and for returns and what you need in retirement. Anyway, I'll put that on the show notes, but we'll definitely come back to that on a future episode. It is interesting though, Jay. The CPI, the weights of the CPI, the items in the CPI. So that's soup, washers and dryers, housing, all that stuff. They are going to change in 2022. I think it could be a subtle change, but I haven't really dug into it. I saw a note on the BLS, the Bureau of Labor Statistics, that in 2022 they're going to use the 2019 to 2020 consumer expenditure weighting. And the way they do that is they look at different states and they roll it up to regions, and then they roll it up to an aggregate. And so it's, what did you spend? And then what did you spend the stuff on? Don't know if it's going to be that much of a change, but it is something to watch for. Jay, I don't know if you have any comments on that.
Well, the way that math is done is never really capturing what people are spending anyway, right? No, in general, people don't spend exactly to the ratios that go into the calculation of CPI, right? And heck, food and energy and the core calculation come out most of the time anyway. So, I know a lot of folks feel that data is not really representative of their actual additional expenses due to inflation. However, I do want to remind people that you need to set a benchmark somewhere to at least look at the rate of change of the same things over time. So I think a lot of people will dismiss that number as, well, that's not really what I'm going through. And that's true. There's probably nobody that goes through the exact rate of inflation that number reports and the weighting that's in that. However, it is a general gauge of the rate of change of all of those different pieces. And so I just, I like to remind people that we know it's not you. We know it's not what you're experiencing. It's not what anybody exactly experiences anyway, but it's just meant to be a gauge for the entire space of how inflation is affecting the U.S. economy.
Yeah, I mean, I think you didn't say it in what you just said there, but you've said before on air and off that inflation is personal to the individual, and I think it's a great point you bring up. If you lived in like when I lived in New York City and didn't really drive, you took the subway. Energy prices didn't really affect me. I wasn't filling up gas. Now, if I took a cab, I suppose energy prices would filter through as a trickle down. But take someone who's retired and is no longer paying for anyone's education, much less their own. If education goes up 50%, it's irrelevant to them. But certainly, it's not irrelevant to the parents who are paying for, have someone going into college in a couple of years. So, yeah, I mean, I think that's like if somebody really. I always said I would do this, Jay, but it seems like a lot of work. Like go to the grocery store and look at the stuff I buy and just start charting it. And do that for a while and do your personal, expenditures. Maybe somebody will create an app for that.
Well, listen, I think, I bet Amazon with their Whole Foods acquisition has been planning on what your refrigerator looks like for a long time now. And they're going to plan on how often you use something and why not track what you paid to have it? I think that's all data that Amazon will eventually give us, don't you think? I mean, heck, Amazon has given us stats on football players right now. I see that on the commercials every week this time of year. Why would they not give me the stats on my milk and cereal too? I bet they could do that.
Yeah, maybe they don't want you to know, but everything you're buying is going up or down. But speaking of prices going up or down, Jay, the other news of the week was Joe Biden was out. I think he was out in California, and he's going to end the shipping crisis. I say this again with a smile and a bit of sarcasm. We've been really early on the container shipping issue. We joke around because during our investment committee meetings, we sort of go around the room and just throw in a couple topics. Doesn't mean we're going to do anything on it. Of course, we're always hedged and we have a systematic process. But it's just the things we're watching. You and others probably laughed at me when I brought up shipping container prices a long time ago. To me, this feels a little bit contrarian. And I did see that for Shanghai to container rates for Shanghai to LA and Shanghai to New York, they tick down. So I don't know, Jay. Maybe this is, and it seems like the congestion is easing in China, where they have been 24/7 for some time. So I don't know, Jay. Maybe this is a little contrarian, and we'll start to see easing of shipping container prices.
Well, yeah. So listen, there is no doubt you were early to the party on this one. Not being wrong early, but you recognized it. Actually, you were on it as soon as that tanker got stuck in the Suez Canal, right? The Evergreen.
2 months earlier, Jay. Because remember that was the thing that one of us saw and said, "Oh no, this is really on the front page." Are you kidding me?
Here comes Derek with more container shipping costs. Yeah. So you're definitely early on it, but we have. It's definitely something that we have watched as a reflection of potential increases in supply costs, for sure. That has started to trickle its way more into mainstream. I think 2 weeks ago, I think some of the news media, I think it was CNBC, did a whole, they had somebody in Shanghai and somebody in a boat outside of LA, right? And then another person was in the port and another person was in Cleveland waiting for the ship. There was a whole big to do on it. And you were definitely ahead of the curve on this one. I am with you from a contrarian perspective that it is played out. It is in the media. It is in the news. It is in households now. I won't say who, but one of the wives of someone on our investment committee said, "Hey, I think shipping container costs are up." And that was it, right? That's the top. Not that she's not educated on this. She is. She's clearly paying attention. But it's like when the The taxi driver tells you to buy Bitcoin, or your stylist tells you, hey, we should have bought Yahoo a few years ago, right? Like whatever. Yahoo, look at me, I'm really dating myself there, but I'm going back to the internet bubble, right? So when I think about these bubbles and how the media then makes it so prolific that it trickles down to everybody, the top is in.
Yeah, I think it's, and I always tell the story. I've told it before. I won't tell the whole story, but I'm sitting in my dentist chair watching, not because I chose to watch, Kathy Lee Gifford and the show where they used to drink wine together, and what was that on NBC? Today Show, like the after. Anyway, so and I remember the rice crisis. That was bags of rough rice, and people were hoarding it at Costco, and prices were going through the roof. And I'm sitting in the dentist chair, and I hear Kathy Lee Gifford show a chart of rice. You never see a chart of rice on CNBC, much less on the Today Show extension. And she says, well, I don't know. I mean, people are saying they're running, you'll never get rice again. Who knows how high it will be? That was the top. That was the top. I actually traded it. I didn't have the guts to stay in the short position, but I made a little money on that one. Yeah, don't trade rough rice, by the way. It's very liquid. Nobody trades that. Or trade if you know something about it. I don't know. But yeah, Jay, I mean, I always think about that. And, that was a real extreme one. So we'll see. I mean, I think if some of one of the things too, I think during the pandemic is like in Arizona, they were talking about, remember toilet paper and different items, hand sanitizer, like you couldn't get it in store fast enough. And there was a law that you couldn't deliver at night to grocery stores. And so our governor in Arizona just signed an executive order and did an emergency declaration, said, no, you could deliver at night. So don't you think, Jay, that some of the post-pandemic and some of the stuff in these crises that we're having will lead to people taking a fresh look at things and maybe, why can't we do this, right? I mean, that's always the case too.
Yeah, and things are different now. Things are changing. You brought up the pandemic there, and I understand you're attaching it to business, but I've been doing a lot of travel. I don't know the next time we're going to be able to travel on an airplane without a mask. Right? I think I've probably been to 17 cities in the last 2 months, and it's regular. It's the regular thing now, right? Obviously, so we always see changes when there's large scale impact to our social behavior, and I'm not sure what's going to stick around on this, but yeah, why not? Right? We are things get better. We are advancing as infrastructure wise and technology wise and information wise. And I think information is probably that key piece. And I think if you could get people to work those hours, then why not? I think that ends up, let's tie this back to the supply chain problem. Let's talk about workers and wages for a minute, Derek, because that continues to be an issue. And I'm not saying everyone that's on getting stimulus checks isn't going to work out. That story's over in my mind, but it still seems a little perplexing to me that we have 4.5 million jobs outstanding still that were lost during COVID of 2020 that haven't been filled. And I see a lot of people working, new workers at certain jobs, don't know how to work the register yet. I'm glad they're doing it, but it just feels like we still have this worker shortage, Derek. And I don't know if you want to play that into the whole supply versus demand driven inflation, or how deep you want to go on that.
Yeah, I mean, I think it goes back to you've been mentioning. I think you mentioned on your one of your media appearances that if we see wages increase much more than expected, or at a much higher rate of change, that could put pressure on, inflationary pressure. On the overall question, though, it's only been, I guess, 2 months since a lot of the states ended the expanded unemployment. I think California is still doing some version of it, but maybe this just needs a little bit more time to settle in. And the other question that we really won't know is, I don't know how many people started businesses that aren't taking these jobs. The survey, it's a survey data. And so one might think that, the Bureau of Labor Statistics has this computer and knows what everybody's doing at every point. but it's a survey and you extrapolate based on survey data and go into something else. But yeah, I think I'm watching that. I'm watching that with you. One thing on inflation, though, I do watch the sticky CPI versus the flexible CPI. And throughout this whole bit, Jay, the sticky CPI, things that are less apt to change, really hasn't moved. I mean, it's 2.8% on the sticky stuff right now. I mean, we were at 2.7, 2.8% in different points in 18 and 19, and nobody was, throwing up roadblocks, right? So the last time that stuff went up was the late 70s. So, I'm not making a contrarian call on inflation. I just think it's really mixed right now. And I think you're right to point to the employment stuff because that's going to inform a lot of our information going forward for sure.
Yeah, when I think about the important data points to me, whether this is supply driven or demand driven inflation, are things like PPI, the producer price index, which tells us the cost that it takes to make things, right? That's supply chain cost, and wage growth, wage rate change, I should say, right? So I watch those two data points as kind of the key items to help clue me in if this is more supply or versus demand driven, transitory or sticky. And the last, between today, which is the 14th, we saw PPI data. The core came in, it was expected 0.5%, came in at 0.2%. So definitely less than expected. And then wage growth we saw on, what was it, Friday, right? That was October. I don't go in dates wise, Friday, October 8th. That jobs report was weak and wage growth was not high. And so, when you look at those things, I'm not convinced it's going to stick around either. I probably feel a little more, uh, what's the word I'm searching for? I guess a little more supportive of the idea that this may not be around too long, and we just have to work things through the system. We got this, it's the pig and the python analogy where you get this bump, and it's just got to continue to work its way through the system, and it eventually will kind of die down by the time it gets to the end of this. Um, it's hard to know if we're there yet. There's no hard evidence to say, yeah, this is cost and supply driven inflation versus just anything that's transitory.
Nope, I agree. And I think that's the thing with all the stimulus is I've more in the camp that was a supply side issue, not a demand side issue. And as we've said recently, if you throw too much money on a supply side issue, you're going to have price increases. So before we transition over to the tech stocks, one thing I'll throw out that I'll be watching is gross output. So that's GO. Gross output. I'll spend 20 seconds on this before I transition. But GDP is the final finished product. That's everything. A baseball hat is just the price of the baseball hat, right? Gross output measures the different outputs at different parts of the creation of the product. So it's the plastic. So though sometimes gross output is something that can give a little bit of a tell on the economy, and I'm just curious what Q3 comes out at. But that's for another time. For this time, though, Jay, I know you did some research on some of the price action before and after some of the key tech earnings. And I thought it was interesting because, you'll explain kind of your analysis there, but it was mixed. And then there was pretty consistent in what happens post earnings. So tell us a little about that.
Yeah. So there is a week every quarter where many of the major tech companies report. So Amazon, Apple, Microsoft, Google, Facebook, they all seem to cram their earnings into one week. And we've kind of labeled that Tech Week internally. Of course, other companies like Netflix and Intel do it at different times. They're also very large, IBM, right? But those are the ones that we feel have A, the large market cap, and B, an influence on not only the Nasdaq 100 but also the S&P. And so when you look at the 2 weeks preceding the first release of those, I'm going to call those big five, right? Apple, Amazon, Microsoft, Google, Facebook. If you look at the first 2 weeks leading into those, reporting, it's kind of choppy. It's up, it's down. There's no real pattern. It doesn't seem to matter. But after the first one reports, there is a pretty consistent pattern that I think 7 out of the last 8 quarters, the NASDAQ 100, some people trade it with the QQQs or the NDX if you know the futures, are the I think it's 87% of the time, right? 7 out of 8 times the market is higher, and it's higher by close to 2% from the first one that reports. And this time around, the first one reporting is Facebook on the 25th. So we're in that 2-week period of chop now. That started on Monday. Could be up, could be down. Certainly, this week has felt choppy. Today that we're doing this podcast on the 14th, it's a strong day in the market, but it hasn't been that way, all 4 days leading into this Thursday. It is a notable pattern. Obviously, nothing's guaranteed. It's not 8 out of 8 times. It's 7 out of 8 times when you look at the last couple of years. So, it's just I think we could talk about the why in a moment, but it is a clear pattern of an increasing value in that tech-heavy NASDAQ 100 after the first one of those large stocks report in that tech week.
So what I'm seeing here, and obviously our listeners can't see this, but paint a visual picture, is when you say the 2 weeks prior to the first report, it's what's the performance of these stocks that you mentioned prior to the release of the first earnings report from the first company that releases. So of the 5, 2 weeks prior to the first one announcing earnings, and then this is the returns. And yeah, Jay, I mean, it is choppy, and I think that's probably, and we see this around Fed announcements, right? I mean, don't you think that's some people trying to figure out, do I really want to take a strong conviction play one way or another? They just want to wait for the news. And then once one announces the news, it's kind of, there's a correlation with the others. At least that's the way I see it, right? It gives a tell once the first one comes out, right?
It certainly can. On an individual stock by stock basis, it's not nearly as obvious as it is versus that whole Nasdaq 100. That's the 100 stocks. I think it's actually 101 stocks because Google's in there twice. The 101 stocks in the Nasdaq 100. You may get a good report out of Microsoft, and Microsoft may not move that much because it might have moved up, but it could ripple through to the other types of software companies that are involved, that are in that index. So, yeah, it's a little bit of, in general, companies tend to, beat earnings. I think the number historically is like 65, 68% of the time, companies will exceed their earnings estimates. That's a little bit of, maybe things are good, or maybe things are, management is, managing their numbers so they could exceed. Who knows? But I think it is true, Derek, that once you start to see kind of the first glimmer of what, those large companies are going to do, it does create that ripple effect of some sort of bullish sentiment, right? And the market isn't always up, right? Obviously, but it seems like during this period of time, the market generally, especially the Nasdaq, generally appreciates.
When I think about earnings estimates, and you and I go back to the 90s, and it was like in the 1990s. Remember the earnings whisper was the thing. So you had the analyst estimates; they had to beat the estimate, and then the whisper number. You don't really hear much about the whisper anymore, do we? But that's. Do you remember that, Jay?
Oh yeah, I do. And listen, we have a friend, a close friend of ours, a friend of Zega, that specializes in trying to figure out the whisper number before the analysts do, and he does it using big data, right? He does it using things like digital footprint and artificial intelligence. But yeah, so there are ways now to get kind of ahead of what a company has said by looking at other metrics. It's, Derek, it's almost like we talked about shipping, but going to the parking lot of a port and looking how many containers came in or how many have been delivered, right? That's the old way, right? Or it used to be maybe buying the 800 number logs for retailers like Sears or anybody that put out a catalog, right? Like you could get data like that where you could be ahead of what actually the company reports, right? That's always been. There's nothing illegal about that. If you do your research, you do your research. That's totally fine. But the whisper number is less important to me these days than the forward guidance is, right? Forward guidance ends up being a much bigger impact, in my opinion.
The other thing I noticed on your data, so you have the 2 weeks prior to the first report, the first report to plus 2 weeks, and 2 weeks prior to 2 weeks after the first report. So, in the first report plus 2 weeks, to me that says, okay, all of the ones that are going to report, they should have reported in those 2 weeks, correct?
Yes, they would have all been within that period of time. And the first one, usually they're within 3 or 4 days of each other. Yes.
So I look at this and I say, okay, if somebody was looking at this chart, and by the way, the outliers are, I don't know if there's anything to the outliers. So you went back to Q3, I think, of 2019. And the outliers really are, it looks like that there's one sort of time when I think the Qs were down about over 4% 2 week prior to 2 weeks post the earnings of the first one. Is that was Q3, Jay? I'm looking at, no, that was Q1 of 21, wasn't it? Huh?
So there's the two outliers were the 2 weeks leading into earnings. The really bad one was Q3 of 2020, but then from the first report to the next 2 weeks, you're right, that bad one. The only one that I would say really is the outlier of the from the first time they reported was Q1 of 2021. So first quarter of this year. Interesting that that's the case, but we could maybe think about if it was the recovery play, where small caps did very, very well. The Russell 2000 did very, very well during that time period, but the NASDAQ lagged. And it was almost like a reopening type of a rotation that we saw in the market. That could be part of the reason for some of that. But you're right, Derek, the outliers are, they're probably limited to some sort of, or maybe accounted for by something that was going on, in the macro environment at the time.
I think one of the other things too that, we're obviously manage option strategies and we're big on volatility. If I look at this and I didn't know anything about options, I say, well, this is really easy. I'm just looking at, the first report to plus 2 weeks, or 2 weeks prior, 2 weeks after. I got a 6 in 8 chance of the market being up. Again, we're only going back to one of the quarters in 2019. I guess the challenge is though, those options will have embedded implied volatility. They're going to be pricier before earnings. So yeah, I mean, if that's a game you want to play, you have to be right, and then you have to have the magnitude, right, Jay?
Yeah, and it's price and time and magnitude when it comes to. I would call this a 2 week trade, a speculative options trade, if that's how you wanted to use this data to trade. We're certainly not encouraging that. It's one of the reason we did this research was because the market just feels like it's got a little pressure on it right now, and I thought it was important for people to know this is not unusual, right? Leading into big earnings, the market has a wait and see mentality, which in general probably means a slight drift lower, especially with the other pressures that are going on right now. So this was not meant to produce, 2 week long call or long put trading results. It was more along the lines of, this isn't anything unusual that we're going through right now. Typically between now and say 2 weeks after the first one of these that reports, which again, we said was Facebook on the 25th, market is generally up. So give it time, have some faith.
I would agree. I bring that up because someone listening might say, "Well, this sounds like good odds. Maybe I'll open an options account and start trading options." Don't do that. Please don't do that. But yeah, it's playing options or around earnings. You're going to pay for that. Everybody know. I don't know about you, Jay. When I first started trading options, I was on a desk with a trading desk, and there are people who would buy straddles right before earnings, and they're like, "Oh, we know it's going to move," so they buy a call, buy a put at the money, and just say, "I just need it to move." And I'd say, you realize that's already priced in, and now you're playing the game of, if you're pricing in a 5% move and you only get a 4% move, then you lose money. That's a tough game to play. And I think getting back to the purpose of the research, we talk to people all the time, and people have, we're hedged, so it sort of takes away the reason to try and time the market. If you're hedged, it's okay. If it goes down, okay. If it goes down too much or enough that I can actually monetize the hedges and buy some lower. But I think I feel like the sentiment right now is there's a lot of people saying inflation is going to be out of control, shipping container out of control, and that's really why I brought those up. Market is likely to be sideways or down. But here, looking at the analysis you've done, it would say, okay, I'm not making a prediction, but it actually looks like once things settled, it sort of rectified itself, right?
Yeah, that's right. And this doesn't mean for the rest of the year, we continue to go higher. It's just, it's a little bit of history that, will hopefully give people some confidence and comfort level of going, okay, I don't have to make any decisions right now. The world is not necessarily falling apart yet. Right. So that's it.
Speaking of not falling apart, the VIX is back under 20, Jay. We're always volatility centric, and we watch that. I still think, though, I mean, for the amount of realized volatility that we haven't seen, meaning the actual price changes on a daily basis, the VIX is higher. And this is an environment where, for a small portion of client portfolios, for the right clients, right, we might sell volatility. It's been a good environment because the whole game with selling volatility is you want to get paid more. You want to get paid for a move that's expected to be greater than the move that actually happens. But Jay, I feel like there's still that COVID premium built into VIX. I don't know about you.
Well, yes. So, we've seen the VIX try to get below 15, a few times this year, not many. It was around June timeframe, and then it tried again in August. But that has been a floor, and that 15, 16 level is an interesting area when it comes to the VIX. And we continue to find that floor. So what a floor in the VIX means is, that it would go down, then bounce up, and typically higher volatility means lower market moving. So, all of those things it's just an interesting dynamic that I think you're right. Some of it is the COVID premium that's still on there, although I feel like that's probably starting to come out a little bit. We obviously have a little bit of the political theater that is playing out that we, typically dismiss. We're aware, but dismiss because I forgot how that phrase goes, but give the government all the options to do, and eventually they'll do the right thing, or maybe the last thing they do will be the right thing. I'm not sure what it is, but I think you know how that phrase goes. That's going to play itself out, right? We're not going to. I shouldn't say we're not. It's highly, highly unlikely that we default on our debt, right? That kind of stuff needs to be taken out, and if that's causing volatility, you should take advantage of that. I think, Derek, that we have one of our investment committee members who would tell us that, look, crypto has worked its way, and the volatility of crypto has worked its way into the broader markets because there are companies, the S&P 500, that hold crypto on their balance sheet, right? So, things like that are working their way in. I'm not sure if we're going to see a 13 VIX this year at all. It doesn't seem like we're going to, definitely not below. I'm not sure if we'll see one next year, right? Especially if inflation continues to be a concern and the Fed waiting to raise rates and waiting to taper. They gave us a little information about tapering the other day. Like, all of these things are, just finding their way into the options market, because if insurance gets too cheap, it's going to be bought up because there's plenty of potential fear in the market right now. More than usual, I would say, right? In the 20 plus years I've been trading. So obviously it doesn't feel like a COVID or a 2008 situation, but there is a higher level of fear that I've observed emotionally within market participants right now.
It is interesting. It's sort of a contradiction in itself. The market on January 6th of 20 was around 3284. So the S&P 500. And then if I want to look at, the market today is 4430 as we're taping this. The VIX on January 6th of 2020, it closed at 1256. I mean, that's, so it just kind of goes to show we're higher. We are 1,200 points higher, roughly. And the VIX, was just about, what did I say it was? 12, Jay? I moved my cursor. Yes.
That's all right. Yeah. There's a lot of complacency at the end of 2019, right? That was a strong fourth quarter of 2019. There was a lot of complacency. And it goes to show that the forward looking or predictability of the VIX clearly is limited. It won't always, predict a black swan event, which I would put COVID in that category. And it missed it. I mean, it started going up and then it really went up. But, you know, when I talk about the VIX, I know a lot of people use it as fear. I think it's more of a speculative index, right? How much people are willing to pay for speculation, up or down. It is forward looking, and it probably is the best metric for gauging the emotional disposition of the market. The market's driven off fear and greed. We know this. I'm going to circle back to Gordon Gekko at this point. And when those emotions are moving, you'll see it reflected in the VIX. What people are willing to pay for a speculative move. That's really what the VIX tells us.
Yep. No, I think that's right. By the way, Jay, I owned a pair of bull and bear suspenders. They had bulls and bears on them. Yeah, cheesy. Say right letters.
I got the
cufflinks.
You do? Okay. I got the cufflinks.
We would have matched.
The bull and bear cufflinks. I actually wore them when we rang the bell at the New York Stock Exchange.
Oh, nice.
I felt that was appropriate.
Nice. Yeah. If anybody wants to go to zegafinancial.com, you can see the picture. By the way, you mentioned crypto, and in the time we have left, I can't let the comment go about crypto of Jamie Dimon. Jamie Dimon basically called crypto. I hope I'm quoting correctly, but some things he can of it's a fraud, but his clients like it. So I have been a Bitcoin or a crypto skeptic, Jay, and I at this point I'm willing to say that Bitcoin is an asset that people can buy and sell. I don't think it's a currency. And in my mind, when you show Bitcoin / US dollar, to me, it's just an asset. And I think there's a lot of coins that are coming into the market. I worry about, Dogecoin was a fake coin, but it is an asset, Jay, and there is tons of volatility in there. And yeah, I mean, the point about bringing that volatility over and yeah, I mean, I think it's an interesting way of looking at it, Jay, is that has to be looked at now in the case for volatility.
Yeah, you can't ignore it. It's in there. It's in the market. Its market cap is growing. I think what Jamie Dimon said was Bitcoin is worthless. Right? I don't know if the most recent stuff was fraudulent. I don't think he accused it of being fraudulent, but he said it's worthless. But you're right. He said if my clients want it, I got to give them access to it because he's also a businessman and a banker. But it's funny. He said that, and by the way, Jamie Dimon has been saying that for over a year now, maybe longer. But they also are in the point of developing their own coin. Now it'll be a tethered coin, like one that's locked into a specific value. But it's hard to say that the blockchain is fraudulent. I don't think we've proven out its viability, security, and capacity yet. But you want to call Bitcoin worthless? Fine. It's what you get paid to host a blockchain. And I haven't heard him say the blockchain is worthless yet.
Yeah. Thanks for correcting me. He said it was worthless. Thank you. I don't want to get sued by anybody, much less a company with billions of dollars and lawyers. So Jamie Dimon, by the way, many years ago, this is probably 93 and 94, I was at Smith Barney and Jamie Dimon was there. And I'm not saying Jamie Dimon and I interacted a lot, but it was interesting because I think Sandy Weil was still the head of Smith Barney, and they had bought Shearson. They sort of rolled up a bunch of stuff, but this was before the Citibank acquisition. And I can't tell you how many people told me, "Hey, watch this guy. This guy's going to be the CEO one day." Like people knew about him really early, so it was kind of interesting to see him ascend, to where he is. So a little insight on Jamie Dimon from the mid '90s. So. There you go, Jay.
Thanks for that. I was that's that has helped me give a little vision here. He has been around a long time. JP Morgan, by the way, we have a friend of ours, friend of this podcast that actually works at JP Morgan. There's lots of CEOs there, right? He's the CEO of the CEOs there, right? Because there's a lot of independent companies under that umbrella. To your point, how they've rolled things up and different business lines. But yeah, I think I saw recently 260,000 employees at JP Morgan Chase. That's a lot. It's a lot of people to employ.
Yeah, I mean they're one of the worldwide leaders in banking. I mean they've done of all the banks. I think they've done even going back to the financial crisis. I mean they were fine and all that. I think for the most part. In fact, they took on, didn't they? Are they the ones that took on Bear Stearns? Did they take on Bear?
They took Bear Stearns. Yep, they took him in 2007. Correct.
And I don't know if it was Wachovia too. Did they take them? I don't remember.
No, that was Wells Fargo.
That was what? Okay. So, all right. Well, Jay, I think we've
Bank of America took Merrill. Yes, we don't have to go down that memory lane.
Well, I think this is good, Jay. You got to test out some material. As I always call it, everyone gets a first look here before you try the material on the national stage. And to make sure we don't get sued by anyone, of course, we're not making recommendations on anything we've said today. The part of what we do, I mean, it always goes back to why we hedge. We always tell people we don't really pick market directions. We have opinions, but it's about putting people in place to have protection on the downside. And then for a little bit of portfolios for the right clients, we might take advantage of volatility. But that's a conversation between you, the listener, and your advisor or us. So, Jay, thanks again for coming on. Appreciate the time, and we'll have to talk succession next time. Maybe not, maybe because we don't want to spoil it for people. But
maybe we'll let it run a few episodes and talk about how much we like it. Right?
Yep, absolutely. All right, this has been episode 138. Jay, thanks again. Good luck on Mornings with Maria. And I will tape it as unless I'm still up, at 3:59 in the morning. I'll watch that. Thanks, Jay. We'll talk to everyone next week.